Dr. Satish, how are you?
Sir, very good. Good to see you back.
Dr.
When did you come back, sir?
Yeah,
Yeah,
just
Dr.
morning I
Harish.
came, morning.
Dr. Harish, are you there in the group?
Dr.
I
Harish.
think he's there, sir.
Not able to find him. Okay, we will start in another 1 minute.
Ajay, sir.
Yeah,
So are you back in Hyderabad?
I'm in Hyderabad, Dr. Satish. Sorry, I missed your program,
No problem, sir.
but
Sir,
I'm going to see in the YouTube.
your book is ready, sir.
Yeah,
I will send it. Your copy is ready. Now that you are back, I will send it, sir.
Dr. Pawan, you are able to see the screen?
Yes, sir.
Yes, sir.
I
Yes,
think-
sir. Yes, sir.
Once you start, Dr. Harish Gopal is there. We'll start immediately. Don't waste time.
Yes, sir. I
Student is
think
ready, I think.
I'm not seeing Harisha. Harisha, I'm not seeing, sir. Maybe I think we'll start. He will
You
join. I'll
start
call
off,
him.
Pawan.
Yeah.
And if Dr.
Yes, sir.
Yashwant is there, just invite him.
Yashwant, sir, may be busy in that oration today.
Okay.
We will.
Maybe you better make it. Admit all.
Very good afternoon. Very good afternoon, all the financial enthusiasts, for this yet another session. For yet another session, interesting session by Professor Dr. Chapai Soren, sir. So it's going to be a very exciting session because he is a very good expert. Nobody believes that he is a pediatrician. Seeing his financial expertise and the knowledge he shares in the financial fitness work group. So I request our director, the lead director for financial fitness program, Dr. Ajay sir, to give his welcome remarks and start the session. Over to Ajay sir.
Yeah.
Ajay, sir.
Good afternoon, everybody.
mute
It's
all
so
of the
nice to
all
see you
participants?
again. Welcome to this Financial Intelligence for Pediatricians from Pediatric Academy of Telangana as a presidential action plan in the series 2. This is part of the F3 program, which we had about 2 years back with the founder president, Dr. Surendranath, and secretary at that time, Dr. Pawan Kumar, continuing during Dr. Arkala Bhaskar, and now with Dr. Alladi Yashwant Rao and secretary Dr. Vamsi. We already had wonderful programs by our participants, faculty. Last time I missed it on 14th May, smart way to invest in Nifty, VIP model by none other than my very good friend, Dr. Satish Vadapalli from Visakhapatnam. I have read in the group the wonderful feedback which he received for his talk. Thank you, Dr. Satish, for that wonderful presentation. As my group's faculty coordinator, Dr. Harish Gopal sir says, though we may record the program, we are not going to broadcast or post it in the group immediately because each speaker takes a lot of time, energy, effort to make the presentation of this 45 minutes, the nutshell, and also in pearls of wisdom in the personal financial management. So it is better to have a live interaction, clear the questions and participate and give the encouragement to the forthcoming speakers and the presenting speaker. And today we have on 21st May, 2023 Basic of Stock Market by none other than our another expert faculty and admin, Dr. Chape Soren. He is the head of the department of SVS Medical College, Mahbub Nagar, Telangana State. You all have been seeing his postings, wonderful postings in our WhatsApp group. He not only mastered basic fundamental analysis of a share, of a stock, of a company, but he went ahead and mastered the most difficult topic, the technical analysis. And each one will answer these three basic questions: what to buy, when to buy, and when to sell. What to buy is by fundamental analysis, which I think he will introduce us to that particular assessment and analysis of a company. When to buy, when to sell, we are going to have it in the technical analysis, and we have got wonderful speakers ahead coming in. I've already spoken to a couple of our faculty members or by admins of WhatsApp group from various cities. We have got wonderful program lined up in June, July also. But technical analysis, let me tell you, is a difficult topic. Don't jump into it. Try to learn the fundamental analysis. And we, as the saying goes, all of us should have a very good small portfolio of shares in our investment purse or in our investment allocation, which Dr. Soren will tell us today. The basic stock market selections of the stocks. Later on, he will tell us how to build the core portfolio and how many stocks are the ideal stocks in your portfolio, how to select them, how to manage them, when to sell them, how to keep them and monitor them. All these things points Dr. Soren is well known to tell us with his own mnemonics and his own way of wonderful shortcuts or even analysis which he has. But basically, by and large, everybody should have an equity in their portfolio of investment. They should have not more than probably 30 stocks in their portfolio. 15 is ideal. Some famous investors have got only less than 10 also. If you have 15 to 35, that's a good thing. Have in the wish list. Whenever there is a dip, SIP mode, you keep investing and build up your portfolio. Have a core portfolio, have a satellite portfolio, which Dr. Soren is an expert and he will tell us. With this few introduction of this topic, basics of stock market, maybe fundamental analysis today, Dr. Soren will take over and tell us subsequently how to build a core portfolio. That is the next week, 28 May. We will have end of this month. And I request Dr. Soren to start the program. Before that, if you have Dr. Harish Gopal to say a few words, and if you have the president in the Zoom participation, Dr. Yashwant to start the program. Thank you very much. Pay attention, take notes, write down with a pen and pencil in your hand with a paper. These notes are really, really pearls, gems from Dr. Soren. It will be, and it will help you for the beginner, for the newbie, or even for anybody to work on it. Over to Dr. Soren. Dr. Soren, please unmute yourself.
Okay. Thank you, Ajay Kumar sir, for the nice introduction.
Sir, you're not audible.
Yeah. Okay. Now, hello. Am I audible?
Yes, sir.
Yeah.
You are audible and your screen is visible, Dr. Soren.
Yeah. So in the next session, actually, we'll be telling about the details of the how to analyze into fundamental technical analysis and to build up the core portfolio. Today, just to understand what the stock market is, how it works, that part we'll be learning. So at the first thing, why we need to learn about the stock market. So while learning the finances and stock market, so basically, why the beginning part in the stock market we want to learn is, suppose anybody wants to construct a house. First and foremost thing he has to do is to check what is the ground where they want to make. Based on looking inspection the ground, whether he has to make the surface an even surface. Then only has to lie a foundation, because understanding stock market is important before initiating an investment. So one should be learning the beginning part or understanding the market and the behavior of the people. Then only one should start investing. Otherwise, it will not become investment. It will become a gambling. That's why we want to make our learning in the stock market and understanding stock market is important. So what we will be learning in the today is the following. The first thing, myth busters. Some myths are there and some are the truth. What is about the stock market? What are the structure of this market? How the market functions? What are the indices? What are the factors which will impact the price movement of the stocks as a market as a whole? What are the risks in investing in stocks and the process to invest in the stock, and the grievance redressal, and what is the tax rule of India about this capital gain tax rule. The first and foremost thing, we're looking at this. First myth is stock market is risky. So many often the people will be advising don't invest in a stock, it is risky. So yes, stock market is risky for those who don't understand what is the market and how to choose the stocks, how to do the allocation and when to exit. But as we are looking for this chart, this is a chart from the 43 years chart of Sensex, which is the index of the Bombay Stock Exchange. So if we look for this chart, if we look for the smaller time frame, it appears like too much of fluctuation. But as one looks from the 1979 till 2023, the Sensex has given nearly 16.5% CAGR over those years. If anybody could have invested in that period, could have got the handsome return over the long term. So what it means, in a shorter time frame, the market is very much volatile due to the various reasons, but over the long term, it is obviously it will go higher up and higher up. So stock market is not risky if one understands it correctly and behaves it correctly. Number 2 myth is stock market investment is only for experts. This is again not true. So I have shown here the 3 investors. If anybody can identify them, you can chart it. You can write it, the chart it also. So first and foremost, one left Radhakishan Damani, he was undergraduate basically. And now he is have a net worth of almost 1,52,000 crore. Second, middle one, what we are saying is Parinjay Valia. He is not from again a finance profession. He is a law graduate. He is one of the finest small cap jar of the investors. Third one is again to become fellow. So Vijay Kedia, he is also a good investor. So it is not necessary that somebody should be extremely knowledge about this, would be a chartered finance or a MBA in the finance is to need. So it is the investment is both art as well as a science, and it requires only a 6th grade mathematics for the calculation. So anybody can learn. As among this group, all of us doctors, we have read so many books about the medical science, but here require a small learning for the financial learning. So which in the next session, we will be telling how to do this minimal mathematics or calculation about the accounting and all. So this is the second myth. Third myth is stock market investment requires a large amount of money. This is also a myth. Anybody can invest depending upon the stock price. Even somebody with 100 rupees can invest in a stock. So it is not the large sum. What is more important in the market is who is able to choose a good business and able to do good capital allocation, able to do the rebalance and stay long as the business improves and the earnings increases. Third myth is in stock market, high risk equates high return. It's again a wrong concept. It's not the risk. It's the appropriately choosing the stocks and holding them till the business performs well. That provides a higher return. So what is needed is internal compounding in a business. So business should be able to reinvest in the profits over a long duration. That creates a high return by internal compounding as well as by re-rating. So that's why what they tell is the penny stocks, they will give a high return. Those are the wrong. Fifth myth is what stock that comes down will go up eventually or vice versa. That's not true. Some stocks may be going continuously upwards. Some may be falling. Various reasons will be there. We will be discussing. So that's why one should not do average down when there is a fundamental deterioration in the business. But if the stock price is going up, one can do the average above. So that is the myths. Now let us come to the today's topic, what is basically what is a stock market. So basically stocks are the financial instruments. It may be a bond, shares, mutual fund or the derivatives. Shares or equity is an unit ownership of a company. So part ownership of a company is the share. So if only share is there, that is share market will take. Stock market constitutes everything, all parts. Market is a electronic platform. There the stocks are either issued, means from company to the investors, or traded among the investors in the stock exchange. So share market is what is used only to deal with the shares or the equity part. And another component is the derivative market, where the futures and options are traded based on the underlying asset. Another is there the commodity exchange or market. So there are the various things like gold, silvers, and even some eatables like dals and all, or oils are also being traded in the commodity market. Now let us come to the share. As I have told you, share is a part ownership of a business. If we look for this, suppose one individual with 3 of his friends starts to initiate a business, and each of them will be contributing 2.5 crore each to make a total capital of 10 crore. So to that, they divided into 4 parts into different shares. So they made 25 lakh each share. So total becomes 1 crore of the share with a 10 crore of capital. So individual have a equity ownership of 25% each. So number of shares is 1 crore. So what we have divided the face value of each share being 10. That's why, because 10 into 1 crore becomes a 10 crore of the total capital what they have done. So now if they are doing a very good business and their business is doing well, so they want to list their business into a stock exchange, because as they, so in that case, two options are there. Either they have to create new shares or they have to sell some of their shares. So here what they are doing, they are selling their own shares. So what individual, they initially they had 25 lakh shares, but they told that 4 members, they will keep 15 lakh shares each, and 40 lakh share they will sell to the other investors in the market. So 60% of the shares they hold, and 40% of the shares they are selling to the investors. So are we think that with the same face value they will sell the shares? No, because they have already grown the business and they are making profitable. They will sell the share with a premium. Now they are issuing the shares in the price, issue price is 100 rupees, they are issuing the shares. So now, you look right, the face value was 10 rupees. Total number of share was 1 crore. They have issued the shares in a 100 rupees. But in that issue date, the stock has been listed with a gain of 20%. Suppose stock has been listed at 120. So those who at that point of time invested, they want to exit, they can exit with a listing gain of 20%. But next few days, suppose in a particular day, after few days, every day there will be closing price of the stocks. The closing price of the stocks into the number of shares tells us the market cap of the company. So next is the anatomy of this market. So who are the participants in the stock market? So Security Exchange Board of India works as a regulator for good functioning of the market, as well as to protect the investors' interest. As the regulator. Stock exchange will be there. Bombay Stock Exchange is the largest stock exchange. National Stock Exchange, and another is Commodity and Derivative Stock Exchange of India. So companies will be there. Investors are there. There are various types of investors. Some are called retail investors, high net worth individuals, domestic institutional investors like banks, mutual fund houses, LIC, then foreign institutional investors, as also foreign portfolio investors will be there. All will be participating. Now there are intermediate. Once an investor wants to invest, he cannot directly go to the exchange to buy or sell shares. He has to go through the intermediary. And these intermediaries the following. One is the brokers. Thing. So there are various brokers are there, like Zerodha is there, SBI Securities are there, HDFC, ICICI Securities, Angel One, Share Khan. So many brokers will be there. So one need to broker account. And then the depositories are there where the Demat account one has to open it, and they will be holding the securities of all the participants in the Demat account. Clearing, membering, and clearing house will be there, and the clearing banks. So whatever the buy and sell happen, they will be responsible the transfer of the money from the buyer to the seller. So few facts about the stock market in India. So there is 17 exchanges are there. 2 are used active trading, that is NSE and BSE. BSE has the largest number of listed companies in the world, nearly 5,500. And if foreign institutional investors hold the largest chunks of the share in Indian share market, while LIC is the single largest domestic institutional investor. NSE has the largest volume of derivative market, and it is third in the stock index future. Only about 2% of Indian household savings are invested directly into the equity. In terms of the market cap in the world, BSE ranks 7, whereas the NSE will be ranking 8. 70% of the traded volume done is only by 100 brokers. So they will be 100 brokers will majority volume. So many people might be doing, but it is volume is very minimal. And that minimal volume not change the index prices. And Nifty is the constitutes of the 50 stocks which are considered from the 24 sectors it includes. So now the types of brokers are there. Two types. Full service brokers, they will be doing buying, selling of the shares. Also, they will give an recommendation, investment recommendations, and they may be helping to portfolio update, financial planning. They do the research and analysis, and other plannings also they help because their charges are higher. Another are the discount brokers. They will just provide a platform for buying and selling of the share. They do not provide any research and analysis of the stocks. And they don't provide a personal service. Now we have learned the structure, how the stock market is. Now the physiology is the rolling settlement, that is flow of funds and flow of the shares. So flow of funds from buyer to the seller and flow of shares from seller to the buyer. So individual, the buyer will be logging into the trading accounts. Then he is putting for the buying. Then once buying is done, it will be depository participant information will go, then to the clearing house, then to the depository participant 2 for this seller, then it goes to the seller. And in the reverse way, the flow of shares will go. Cash will be moving in one direction, and ultimately from cash has to go from buyer to the seller, and share has to come back from seller to the buyer. So now the settlement is done T1, means day 1 of the transaction is done. Day 2, there will be settlement of the shares will be there. Now the index. Index is the barometer of the stock market. It tells us how the market sentiment is there, whether it is going up and going down. So various indices are there. So common, the broad index, market index, and these index are formed by collection of the largest and most liquid and financially sound companies listed on the stock exchange and based on the market capitalization. The common what we know is Nifty, which is 50 stocks from 24 sectors. Sensex is the top 30 stocks. Other is Nifty next 50 indexes from 51 to 100 stocks. And BSE 200 is first 200 companies. So there are the indices, the different sectors also constitute the company from a particular sector, like Nifty IT index, bank index, energy index, FMCG index. Some indices are from the thematic. These are created based on the different investment themes, like manufacturing, commodity, consumption themes. And some are there also strategic indices. These indices are designed based on the quantitative model, investment strategy, like low volatility index and equal weight index or Nifty Alpha 50 index. So these are the strategically built indexes. So why the indices is needed? So these indices are needed to sort for the wide range of stocks and add passive investment. Some will be doing the Nifty index funds, index ETF investment. And this is what represents the sentiment of the market, how the market is performing. It is going up or down, it tells us. So, and there is a representation of entire market or a segment, it tells us. So these are the helpful for the indices. And we can compare the indices from one country to other country. Next is market capitalization. So market capitalization is the number of outstanding shares into the current market price of the share, each market cap, what we have discussed in the beginning. So first 100 companies, listed companies, are considered a large cap. 101 to 250 companies are considered mid cap, and 250, 251 onwards are called small cap. For an individual to invest, depending upon the risk appetite, the large cap are lesser risk, volatility will be lesser as compared to the small and mid cap. Similarly, potential to grow higher is more in the small cap, as well as risk also. So depending upon individual's risk appetite and understanding of the business, needs to invest in a mix of large, mid and small cap. Now why the indices moves ups and down? There are various factors are there which moves the indices. It may be at the micro level or a macroeconomic level. So common macroeconomic data are the GDP of the country, inflation, unemployment, national income, and occasionally it may be geopolitical scenario and the government policies, they will be impacting. Some things are favorable to the market, the stock price increases. When it appears unfavorable for the market, it will reduce. And inflation is one of the things which is always inversely affect the market thing. When there is an increasing the inflation, price it increases. So when the price of the things increases, the government tries to increase the interest rate. So when the interest rate increases, the liquidity comes down and the investors will not invest much in the stock. So it reduces. So increase in the price will not rise in the indices. So many other factors are there which may be related to the individual companies or particular sectors. Next, we might have heard the word bulls and bears. The bull market is considered when stock prices are rising or is expected to rise. And reverse is the bear market, stock prices are falling and expected to fall. And one thing is, most bull markets, they stay over longer period, but bear market is shorter. We have seen during the 2020 COVID fall, it has fallen over 2 to 3 months. Subsequently, it has fallen near, I think so, February last to the March first week or second week. From then onward, the fall was very steep, but slowly it has started rising to the present level. Now, correction is considered when the drop is in the indices is 10 to 20%, but crash, we tell it is a sudden and sharp drop of indices of 20% or more. Is the crash. Next, to understand market bubble. This understanding is very much important because when there is a very high sentiment of the people of investment occurs during this bubble phase, and often those who invest in that particular point of the time, the bubble is likely to blast. So how to identify the bubble? The prices are very high relative to the fundamental valuation. If somebody checks the stock price, or the P of the last 3 years or 5 years, if the P is very high during that period of the time, whether the market P, we consider the Nifty P of more than 25, sometimes reaches 30. So those are the identifying point of the bubble. Normally it will be, should be around 18 to 20 or so is the good time. But if it beyond 30 or so, it reaches 25 beyond. So it is the forming of the market bubbles. high leverage. So that point of the time, people have a much of sentiment. So they will be taking more loans to invest because they are thinking everything is rising. They will make a huge profit. So that point of the time, the popular brand, there will be much of oversubscription occurs with the IPO. New IPO all will be launching, and as the sentiment is good, more subscription occurs. And high market cap to GDP ratio will be there. Normally in India, the market cap to GDP ratio should be around 75 to 80. But if reaches the 100, so one has to think that there is a stock market bubble is started. So if that is the occasion, somebody starts investing, as you know, market is always works in a cycle. Cycle will be there. So it is peak means it likely to fall back. Next thing, the recessions and depression. So recession is contraction in economic growth that lasts for a couple of quarters, few months. It will take or till 1 year. Whereas the depression is a severe form of economic downturn, which may last for few years. In the recession, people and businesses reduce their spending and investments are down. But in depression, the after effects are much deeper. Their investors' confidence is at all-time low. So there are no investors will come during that phase. So recessions can hurt a specific country or some countries in a region, but the depression, as it sustains over the longer duration, it may impact the other countries at the global level. Negative GDP growth for the 2 or consecutive quarters, one has to think of recessions. So 2 quarters are doing. But in depression, drop in GDP growth by more than 10% in a financial year. So we'll be considering quarterly result, 2 or 3 quarters or within 1 year is recession, whereas drop of more than 10% over a year is considered a depression. Now we have learned the basic things. Now suppose one wants to start investment process. So we need some prerequisites to invest. So these are the mandatory things. So one needs to have a trading account, demand accounts, and the saving accounts. Trading accounts with a SEBI registered stock brokers. As I have told you, 2 types of brokers are there. Okay, discount brokers and regular brokers. So, and they are the members, trading members of the exchange. So we can buy and sell through these brokers only. Next is saving account, where we will, from the money will be transferred or we will be getting back our money to that account and it will be linked. Third is the demat account, which will be holding our shares in an electronic form. So these are again depository participants, CDSL and NSDLs are there. They will be storing all our shares. So to make in the some of the banks, they will have a 3-in-1 accounts. So with one account, all are interlinked. So following documents are necessary for opening these 3 accounts: PAN card, Aadhaar card, cancelled check, proof of the address, and passport size photographs. Now, process for opening a demat account. One has to fill up the opening form available with the depository participants, digitally sign it and submit it to depository participant clients through the broker. So which this digitally signed form will be defining the rights and duties of the depository participant and the person wishing to open the accounts. So one needs to read carefully while signing these forms. So then fulfill the KYC note by submitting the copies of the requested documents and complete the verification process online has to be verification to done. Then individual will receive a client account number, which is called client ID, also the depository ID. So this combination of the two numbers provides a unique identification number for this particular system. Now we have opened the accounts. So once open the account, next is how to invest, the process. So there are two markets are there. One is primary market, another is secondary market. Primary market is when a company or business needs money or wants to sell some of their shares. Either they will be selling the new shares or selling their already existing shares of the promoters. So in that case, that is called the primary markets. Here so companies will be raising the funds. So initial public offer is where the company goes to the public for the first time to raise the capital by selling equity shares. That is called initial public offer. Now another is follow-on public offer. So what is it? So follow-on public offer is nothing but the listed company wants to further raise the funds by selling equity shares. That is follow-on public offers. And one more is there in the rights issue. Right issue is again the company will be selling the shares to those individuals who already invested into that share. Those are rights issues. Existing shareholders, they will be selling to the shares. And secondary market is when somebody has already shareholder, he cannot sell back the shares to the company. He has to sell to the other investors. And that process is done in the exchange. Whenever the buying and selling occurs in the exchange, that is secondary market. So there is no issuing by the companies here. So now in the primary market, two things already we have discussed. These are the public issues. IPO is the press issues, means new shares are selling, and offer for sale is already those who are having existing shares, they will be selling those things. Next is rights issue. Already I have told you, right issue is the selling shares to those already holding particular shares. Bonus issue. The bonus issue is the company can sell the sums, say give the shareholders a share with any extra amount. They will not charge any extra, so that what happens is the face value will reduce it. Now preferential shares are given to the promoters or the employees or some strategic partners, but those preferential, they will not much of rights for the voting rights will not be there. And in the right issue, when the company issues the shares to those existing shareholders, they will be given the shares at discount rate. Now the IPO process, the first time, when the company issues shares, so that is called initial public offering. This application is made through the net banking account via application supported by block amounts. So once they declare for selling the shares, so that time they produce a red herring prospects about what the company is doing, how the business performance is done, what for they are issuing the shares, what they will do to that amount. They will write it there. One needs to study it. Based on the thing, one has to apply through the net banking. Example is, suppose you are applying a shares are worth 1 lakh. This amount will be blocked in your bank account. Once the shares are allotted, the exact amount is then debited with the balance being released. and then the share will get listed in the exchange. Then you can begin to trade them. It is the primary market. Now, secondary market is in the exchange per se. So the company does not comes into play much here. Though, so selling and buying occurs between the two investors. So one needs to log into the trading accounts, select shares that want to sell or buy, decide the price. It may be a market price or it may be some limit price, fixed price you want to buy or sell. Then has to place the order. The system matches the price the individual has bidded to the asking price of some sellers. When it matches, automatically buying selling process occurs. And this can be done either through the mobile phone or any internet, physical orders, and place an order through the mobile phone. And now most of them is done by online trading. So who are the participants? So there are traders and investors. So trading is nothing but short-term buying and selling of the shares is the trading. Here the traders take the advantage of the volatility. So they will be doing either when the good traders, they can make a profit while by selling also or by buying them. Both way. Investment is putting the money to work so that it can grow over time. So it is a long-term investment. So investor take advantage of even out of the volatility. So as we have done in the initially, over the longer duration, there is a impact of volatility goes off. In addition, the investors, they will get the advantage of the dividend. So in investment, so we take the advantage of there is one is dividend, another is capital appreciation as the share price increases over the long time as the business performance improves. So the traders can be day trader, scalpers and swing trader. Day traders will be doing over few hours, but scalpers may be doing within few minutes or few seconds. Order they might be putting. Okay, somebody might have put in the 9:30 and they may be doing a selling that in the 9:45. So these are called scalpers. Swing traders, they will be doing for a few days or weeks. These are the traders. Investors are again various types of investors are there. So their investing strategy may vary. Some are called growth strategy, value strategy, and income strategy. The growth strategy is what? When the stock price is growing or business is improving, even if a higher price, they will buy it, thinking that stock price will go further high as the performance of the business improves. Value investors, they calculate the intrinsic value of the company. When they think that intrinsic value of the company is higher than the present stock price, they invest. And when the present stock price comes to the market price, they sell it. And third kind are income investors. Basically, the income investors are the individuals, they will be requiring a regular dividend from the companies. Some companies, they will be providing a regular dividend. They are income investors. So next is, Next is the types of the stocks. There are various types of stocks will be there. Some are considered the blue chip stocks. These are the large cap, basically, as we have discussed. This is the first 100 companies. Top 100 companies are the large cap stocks. Next is high beta stock. Those stocks which are much volatile are considered the high beta stocks. Defensive stocks. Example of the defensive stocks, some of the consumer businesses, first Britannia and all, Hindustan Unilever, they are defensive stocks. So whenever the stock market falls, they will not fall much. Whenever it rises, they will not rise too much. Those are defensive stocks. Some stocks are cyclicals. Cyclical stocks, they will have a shorter, in share market, everything is cyclicals. So we consider cyclical as a timing of the how long the cycle persists. Some may be very short cycles, maybe few weeks to months. Some may be 1 or 2 years, and some may be doing 5 to 7 years. The common cyclical stocks, the paper industries, cements, metals, they are cyclical stocks. So usually the investor perspective, long-term investor perspective, these cyclicals, we consider them in our satellite portfolio. When the cycle starts rising, we need to invest. When it peaks, either stock is peak in the price, peak in the margin, okay, peak in the sell. That's the point the cycle again reverses. Value stocks already discussed, growth discussed. The momentum is when the very rapidly stock price is rising. Within a shorter time span, some few people invest in a, they will take the benefit of rapid rise in the stock. Now, the types of order and the positions. Now, two types of the orders are there. One places the stock market orders. So as I have told you, one is at the market order. The market order is the individual logins, chooses the NSE or BSE, chooses the particular stocks, and chooses the market order. Means whatever the price is there, in the same price, it will get nearest price, same price, selling price. And the limit order is, he wants to fix a particular amount, he has to set it. I want to buy in this amount on this share. That is limit order. Positions can be delivery, where we pay the cash and take the share. That is CNC, it is called cash and carry order. Another is intraday trading. Means same day they have to invest, whether buy or sell, and same day needs to be exited. That is called square off. In the trading, there may be these two are called, one is long position, another is short position. In the long position, the investor first buys the share, then later it sells. So outlook is here the bullish. Suppose it is buying the stock at 100 at 9:30 a.m. and sells the stock at 102 at the 1:30 p.m. and books a profit of 2 per share. This is called long position. And short position is initially sells the share, then later it buys. Here the outlook is bearish. So example, sells the stock at 100 at 9:30, buys the stock at 95 at 1:30. So he books a profit of 5 per share. So these are long and short position. Whenever we are buying this stock or selling the stocks, so we want that contract note, the brokers gives a contract note. Always one invested individual supposed to correctly check the contract notes are correctly received or no. And with this contract note, individuals need to make a journal of sale. Each individual, each investor needs a journal. So we can maintain at what price and when we have bought and when we have sold the thing. Then only we can calculate it out whether we are making profit or loss and how much % we are making the things. So that mandatory is making a journal, investment journal. So what is a contract note? It is a record of all transactions, confirmation of trade done. In case any discrepancy is done, immediately one needs to contact the broker. And this contract note will be containing the following things: details of the transaction done, date, time, price, quantity, trade ID, and whatever the various charges levied. So, and this should be received within the first 24 hours of the date of execution. And electric contact note are immediately sent by email. Can opt for some people for the opt for physical contract also, but and also the quarterly statement of the funds and securities the broker gives to the investors also. So this is one has to surely see, because otherwise sometimes there will be mismatch will be there. one cannot identify. Another is consolidated account statement. It is a single or combined account statement which shows details of the transaction made by an investor during a month across all the securities of the demat accounts as well as the mutual funds. So in order to get cash, one should need an PAN number with a stockbroker and depository participants. So we'll be receiving all through this. Whenever we are investing, whether buying or selling, there will be brokerage charges, and that charges will differ from trading and investment, and also may differ from broker to broker. Variations will be there. Other statutory charges are GST, stamp duty, and security transaction tax. So in investment, there are some corporate actions will be there. One is the dividend. Dividend is part of the company's profit which are given out to the shareholders. These are the dividend. So if company is providing a dividend, so one, that means company might be making profit. Make it sure during the dividend period, company's debt account is not increasing. So company should not be giving a dividend by taking a loan from the bank. Stock splits. So stock splits is, suppose the initially what we have discussed in the first 4 members are investing. They have the face value they have created 10. Now they want to reduce 10 to 5. Suppose present stock price is 100. Present stock price is 100 is there. And the face value is 10. So if they are splitting into 2, so the number of stocks will increase. Suppose one is having 100 shares, it will become 200 shares. But as the face value is reducing, there is a net worth will not change. Wealth will remain the same. Only the number of shares increases. This rights issue and bonus already we have discussed. Now, is there risk in investment in the stock? Yes, there are so many risks are there, as we have told. There are so many factors which affect the stock price. Some are related to the company or the sector. Some are unrelated to the company. Those are unrelated to the company are called systematic risk, maybe interest rate, economy risk, inflation risk, geopolitical risk. Those are not under the control of the company. But some risks are there related to the particular business, promoter related to the promoter, or particular sectors may be going up, some disruption is happening in that particular sectors. Those are the things. Or business performance of the business. So these risks can be minimized by investing in a few number of stocks by diversification of business into different sectors, different geography, and different market caps. One needs to 15 to 20 stocks with 6 to 8 sectors in a different market cap and different geographical distribution of the business. So in the next session, we will be telling details about the diversification and portfolio. Now, whenever there is any discrepancy happens or dispute happens with the broker and investors, the investor should immediately question the broker about any transactions that you do not understand or did not authorize your trading members to do. Investor should raise such complaint in writing to the trading member and retain copies of all related correspondence done with the trading member. In case your complaint has not been addressed by the trading member, file the complaint with the stock exchange. In case you do not receive any satisfactory response or redressal of the grievance from stock exchange, well, you may file your complaint with the SEBI complaint redress system. Now, mobile app also available for SEBI complaint redress system, that is course site. complaint by exchange can be filed investors redress system via either online portal, email, physical letter, or complaint or the mobile applications. In case agreed by the resolution given by the stock exchange, approach the investor grievance resolution panel will be there. Then if it is not solved there also, then take up the matter via arbitration to a quasi-judicial mechanism. So long list process are there, but one most important thing is all the transaction is done. One has to read the contract note and also check the demand status. Both should be matching it. Now, the last part we will be coming is the taxation on the capital gain. The investment of more than 1 year in the stocks are called long term, and long term capital gain tax is 10% above the 1 lakh. First 1 lakh is no tax, and all the short term capital gain tax is 15%. And there is an option are there set up or carry forward of the capital loss. Loss from the speculative or trading, intraday trading, can be set up against a profit from the intraday trading within first 4 years. And long-term capital loss can be set up only with the long-term capital gain until 8 years. And this is very important. Some people may be losing a capital loss, but they are not setting it up against it. Now, third one is short-term capital gain tax can either be set up using a short-term capital gain or long-term capital gain till 8 years. So that's all from my side for about the regular aspect of the stock market investment, and wishing each one of you to become a compounding machine for the good investment. Anybody has any questions? I'll be happy to answer. Sir?
Yes, thank you, Dr. Chapaisaran. I think that was a very wonderful presentation of the basics of the stock market in detail, almost like a postgraduate student class in pediatrics, telling us about anatomy, physiology, and the flow of the markets, divisions, and chapters and subtopics. Thank you very much, Dr. Chapaisaran, for that wonderful talk for the beginners, basic investors, and newbies. There is one question about, of course, you have covered it, but those who have joined late or not paid attention. Sir, what is the difference between the bonus shares issued by the company or the rights shares or the split shares?
Okay.
You have covered it.
Does
it give any benefit splitting of the shares to the retailer investors?
Yeah. Is it visible, sir, slide?
Yes, sir. Yes, sir.
Yeah. Okay. So let us see here that now if you are looking at the right side, stock split. Okay. So here the face value was 10 was there, and market price was there 10,000. Number of shares with an investor is 1. So now the companies, as the price is very high, participants may be lesser. So to increase the number of participation from the investors, company will be splitting the stock price. So now the post stock split, it is 1:10 split has been done. So the investor who has the 1 stocks now is getting a 10 stocks. Number of shares is becoming 10, and the face value which was 10, it has become 1, and the market price is similarly it is reduced it from 100 to 10,000 to the 1,000. So by this splitting of the stock, the many investors who we are thinking that 10,000 was a bigger price, the participants numbers will increase. That is splitting.
So basically, there is no use to the investor as such. Face value is decreasing from 10 rupees to 1 rupee. The market price is decreasing from 10,000 to 1,000. So more participants are there. That's all. More shareholders will be there.
Yes.
Am I right, sir?
Yes, and after splitting, there is a chance stock price may appreciate for few days actually. Okay, because investors may join.
Flip.
Yeah.
Yeah.
But over a long term, it does not have any impact.
So a bonus and rights issue are very clearly mentioned by you in this
Yeah.
slide. I think
Yeah.
participants kindly refer to this. Dr. Arun Manglik has mentioned, I don't know how it will be answered. Can LTC loss on property be offset against LCTG in shares and mutual funds? Any idea, sir?
No, sir. No, sir. I don't have.
I think Dr. Balwan Jain sir's talk will be able to clarify next time regarding this question, Dr. Arun. Any other questions? You can unmute yourself and directly ask Dr. Chapeswaran sir. Dr. Does the bonus share affect the face value? Dr. Rajesh Kulkarni has asked. Does the bonus share affect the face value? Soren sir.
No, 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 sir. No, sir. Whenever the face value impact, it will be getting a split.
Thank you, sir. Any participant can unmute themselves and also ask the question directly. If it is not possible, I request Dr. Pawan to make them unmute and ask. Or you can post it in the chat. I will ask for you. So,
Yeah.
Summary of the whole thing is, you should invest in equity, because equity gives, as sir as opening statement has said, at least 14 to 17% of CAGR over a period of 43 years history, he has mentioned. Over a period of time, the stocks will go up, most of the good company stock, and try and see that you become an investor in the first rather than a trader. He has made a difference between investor and a trader. Investor is for a long-term, trader is for a short-term. To become a trader, you have to learn a lot of technical analysis, apart from fundamental analysis, which sir will take in the next class. So, equity investment, also risk benefit, he has also given a good chart. If you invest more than say 15 to 30 or 25 stocks, your risk does not get equally reduced, this chart. It gets flattened out. So basically, if you have a total portfolio, say about, if you see 30, and market risk will not decrease but flatten out. So probably you are better off with a small portfolio of less than 30 stocks, of a good stocks. You can also monitor them annually, if not biannually. Sir always says, Soren sir, water the good plants, flowering plants, and remove and throw away the weeds.
Yeah.
Don't water the weeds.
Yes, yes.
Dr. Satish, your comments, please. Unmute yourself, Dr. Satish. Yeah.
Sorry. Actually, fantastic session, sir.
Yes, sir.
Although I have heard your sessions on phone and personally also, I still learned being a part of this session, and people are still trying to enter your session, as you can see. Anyway, Doctor, one good thing you have mentioned is encouraging people for equity.
Yes,
and
sir.
giving a basic idea. Many people are asking on the of this session, which can help them understand equities better.
Sir.
Your voice is breaking, Dr. Satish.
1 second.
Can you type the question?
Yeah, is it visible now, sir? Is it audible now?
Yeah, audible.
Sir, many people are asking that can you take an extra session on basics of stock? As you can see, many people asking, can we have an extension of this session? One session was
Yeah,
small
next
enough.
session, sir, next session is there for the stock portfolio and how to analyze stocks.
Fantastic.
There is
Sir.
having a second session next week only, 25th
Next
May.
week, sir, there it is.
How to build a core portfolio is the title.
Yeah.
Dr. Soren, there is a good question.
Yeah.
What is the difference between face value and a book value? I mean, those seniors know that, but can you just clarify what is the book value and what is the face value of a stock?
Sir, I'll go back to that same slide, sir, when I started. Okay, I'll show you this here. Okay. Now, look at this slide, okay? Now, if we're looking this side, this is the face value. So now what will happen to the book value of this share? So book value of this, the face value is 10 rupees. The book value becomes what is the net worth of the company. So what is 10 crores here becomes. So each 4 shareholders are there, 4 promoters, 2.5 crore each. If we'll add them all together, that becomes the book value of the company at that point of the time. But face value is only 10. Is it clear, sir?
Yes, sir. Yes, sir.
Yeah.
So the book
Question,
value differs from the seed money.
Yes.
Face value is the issue price, what
Yeah.
the company issues the share in the beginning. That will be the face value.
Yeah.
Premium, we have already mentioned. Some companies, when they come out as an initial public offer, will give a premium if that company has a good brand value.
Yes.
Okay. Superb, sir.
Sir, Soren, sir, in continuation with the questions in the chat, somebody has asked about the importance of T+3 or T+1 settlement days. Is it good? Is it bad? Is it like useful for retailers?
T+1. T+1 is good, na, sir?
Previously, there was T+5 and T+15. Is it better than that?
No, yes, sir. As early as the transaction is happened, completed, that is better.
T+1, if I am allowed to comment, is in the favor of retail investor, because he buys the stock, he gets the delivery within T+1.
Yes.
It won't be lying with the broker. It won't be lying with the company. It won't be lying with intermediaries. It will be between the stock market and with the investor. So it is there in your pocket what you buy. It is like going to a shop, you're buying a 100 rupees worth of a grocery, you immediately get a grocery in your bag, right? But it is not like earlier, you pay today and 10 days later the Flipkart or the Amazon is delivering to your house. You don't even know if it will come the correct share to the correct address or not, or when it will come. In between these 10 days, people will utilize that funds.
Soren, sir,
Out
of your presentation question, everyone is interested to know which is your favorite stock in your portfolio, which people can look into strongly at this point of time to buy. People know you have got a very strong portfolio, very lucrative portfolio. Ajay sir, can I ask this question and leak his secrets?
Very difficult to answer.
What is the question, Satish? I was not listening. Sorry. I was just looking at the chat box.
Basically, Soren sir has got a very attractive portfolio. People want to know one of his secret stock picks, which they can invest at this point of time. They want to take the opportunity of asking him his best picks.
See,
Satish sir, it is already public.
SEBI registered advisors. Number one, it is not ethical, morally correct to tell the stocks advisory on our group. It is a public platform. It's a teaching platform. So best way is to learn yourself, learn to earn. Learn good stock market books or share market books, personal finance management books, and also interact with Dr. Soren directly or indirectly. He is a good teacher. He is the head of the department. He knows how to teach MD pediatric students, and we are all postgraduates. We read thousands and pages of books over our lifetime and during our study period. Reading this personal finance books is very easy because interesting subject and you're passionate. So read Dr. Satish Money Matters book and you will learn more material there.
Yes, sir.
So,
Sir, but
Dr.
Suren, sir,
Satish,
the question,
Dr.
the question
Satish,
still remains open. Just not advising, but sharing which is a good sector at this point of time to look into. I will not leave you.
now again, Dr. Satish, actually difficult thing because always individual sectors we don't focus actually. Always as we are making the portfolio of multiple sectors, and almost my favorite picks are on the always in the public. Okay, so recently that Murugappa and all I am liking the Chola Finance and the TI Tube Investments.
So there is another way of answering this question, Soren sir, if you permit me to. So Dr.
Yeah.
Satish question, what is the favorite sector? Go to Nifty 50, see the weightage of the companies and select which sector it belongs to. The top 5 sectors are the current favorite sectors of the investors.
Okay, Capital Good is doing very well, but how long it will persist, we don't know.
And
Okay, since last 1 year.
And remember all the friends, participants, we are aiming for 7 to 10 years of investment horizon. Today, one sector will be in trending or popular. Tomorrow, that sector will fall down. There is another sector which goes up. For example, the motor automobile sectors was a cyclical sector. I
Yes.
remember 2 years back, Dr. Satish told us that not to buy cyclical sectors at all. But today, the automotive sectors, one of the popular company, has grown up so much. So it is a trend. So you have a 7 years, 10 years period. Don't panic. Don't sell or buy with the trends. Go for the fundamental analysis. See a good company, how the background of the company is there. And Soren sir will tell us, read fundamental analysis, how to do fundamental analysis. A to Z about it, and then invest, have a conviction, believe in your conviction, what you have selected, and then stick with it. Definitely will go up.
So,
So,
for all the participants, the last thing, this is actually should consider as a task to find out the businesses like this. So this is just a 10-year chart of one of the stocks. Forget behind the particular stocks. Okay. So it has been taken 2013 May to this May. So plot the 10 years chart, make into a rectangle, draw a 45-degree angle, and find out the stocks which are making 45-degree in the last 10 years. And you can bring your list for the next session, so we can discuss it and analyze it too.
So stocks which make more than 45-degree angle.
Now, look at this. What this is a chart has been prepared. Okay, so I have taken a chart of the 10 years or so. Okay.
Okay.
Now I have made a 2 vertical line, 2 horizontal line. Vertical lines at the 10 years back exactly, and today's date 1 more vertical line. And horizontal lines, the price in the 10 years back, and 1 more horizontal line at the today's price. Done. Then I have joined the line to 45-degree. Able to see this one to this?
Yes, sir.
Yeah. So now to find out what are the stocks are making 45-degree and minimal fluctuation from that same line. Either maintaining the same line, should not be too much up and down from that line.
So I think you are talking about volatility from the average.
No, volatility should be less.
Very
And
less.
should be maintaining that 45-degree angle.
and the price rise
Less
trend is
volatility
there.
and
What
high
I'm
growth
seeing
with
is
less volatility.
price rise trend.
Yes.
Okay. So if there are no more
So if
questions,
you allow me one small announcement, sir.
yeah.
In the last session, people asked me that my book got overbooked and became unavailable. So announcement, it's available now. I have shared the link in the chat box. And thank you so much for the overwhelming response. After the class, there were like 50 books sold out in 5 seconds only. And now it's available again. So anybody who wants to understand, what macroeconomics drive, how they drive the microeconomics, please go through this book. This is an excellent book for investors. Yeah, thank you so much, sir.
I congratulate Dr. Satish Vadapalli for authoring this book and releasing it. I'm proud of you. He has been a consistent learner of personal finance from past many years, and he has passed his MBA in the first attempt. He has become a certified advisor and a research analyst of the stocks, and he is a wonderful pediatrician, wonderful human being. Please utilize Dr. Satish also his learning, teaching tips. I would call tips, teaching material, and also he is running his own firm of investment. Thank you very much, Dr. Chapeswaran sir, and Dr.
Thank you,
Pawan.
sir.
Kindly give the closing remarks. We will have a chapter, part 2 of same topic, how to make a core portfolio by Dr. Chapeswaran in the next talk. It will be, link will be posted and announced. Thank you very much. And further, in the WhatsApp group for the next 1 week, you can post all your questions from your friends. And I request Dr. Chapeswaran sir to kindly answer patiently and completely to all the questions. There may be simple, they may be complicated, sir. Kindly help our participants of the FIP F3 group. Thank you very much. We will now close the session.
Thank you, sir. Thank you. Thank you.
Yeah, Dr. Pawan.
Suren sir, one out of box question. Do you want to answer why 2000 was demonetized?
Dr. Satish, lot of postings has been there, lot of material up and down is going. I think Dr. Maulik Shah has already said, let us not discuss about 2000, close the chapter. Dr. Pawan, are you there? Okay, Dr. Pawan is not there. Thank you very much, Dr. Chapeswaran sir. See you next week. Thank you very much. We can now leave, end the session.
Okay, thank you, sir. Thank you.
Have a good day, sir.
Bye.